All right, the Federal Reserve will meet today to make its second interest rate decision of the year. Economists predict the Fed will hold rates steady, keeping the benchmark rate at 4.25% to 4.5%. The Fed hit the pause button back in January, citing two key factors: a solid job market and stubborn inflation. For more on today's Fed meeting, I'm joined by the least stubborn person I know, CBS News business analyst Jill Schlesinger, here in Studio 57. What do we know? You might be stubborn, actually, because you're very consistent with your advice and guidance. What do we know about what we will expect today?
I think what you said, we're going to see no action. I think the Fed is in this position where they can afford to wait. And by the way, Federal Reserve Chair Jerome Powell has said that. He literally used the words, "We're in no hurry." And we're in a great place to see what happens next. So when we talk about what happens next, you know, you would say, like, oh, we paused at the last meeting, and then we got a better than expected inflation report. The jobs report looked okay, but it feels like the whole world has turned over in just 30 days.
Right.
And so what the Fed is focused on is tariffs. And while these tariffs are in place, a couple of things are happening. One is that people are spooked by them. We've got confidence readings that show that inflation expectations for the next 5 years jump to a 30-year high. So that means we consumers are freaked. When we are freaked, then what happens? We pull back on our spending. We're 2/3 of the economy. If we pull back on our spending, then that could slow down the economy. So the Fed is waiting to see, will prices go up from here? Will the economy slow down from here? You know, it's weird. They've got two jobs. Sometimes those jobs are in conflict. One is we want to make sure prices are stable, so bring inflation, the rate down to 2%, which is where they want it to be. But on the other side, they want the economy to be strong enough to produce jobs. So sometimes that's in conflict.
And we're now hearing this term of stagflation, which might be something predicted and expected. And as you speak about people pulling back on what they spend, Forever 21 has announced its filing for bankruptcy. It may be a bit of a punchline and a joke. Women always want to look younger, but it speaks to a low-cost retailer struggling. What does that mean? You know,
let's just talk about stagflation for 1 second and just define it. A stagnating economy as prices are increasing. So that's a terrible combination. The idea around a retailer having a tough time in this environment does not surprise anyone who's been watching the retail market. Listen, we've heard from Walmart and Costco saying we believe our lower end consumers, those who make, you know, less than, say, $80,000 a year, which in some places is good, but they say those people are already pulling back. Then we had news from Kohl's, Macy's. The department stores are seeing that. So when you think about Forever 21, I think there's a lot of competition for those dollars. And if I don't need new clothes, then why not? I'll pull back. I got to save it to pay for my avocados.
And well, let's not forget, the average income in the U.S. is somewhere around $50,000, $60,000
It's gone up a little bit more than that. But what is clear also is that there are certain prices of certain things that are really high, and that includes childcare, which eats up a ton of a family's budget. Rent eats up a ton of a family's budget. So I think that even if wages have gone up and it's good overall, for a lot of people, they're still struggling. So you know what? They're not going to buy an extra sweater this week.
Right. There's some things they can cut back on.
Exactly.
Jill, always great to have you here. Thanks for joining us.
Thank you for having me.